Hello everyone, this is Terry with Futures.io, and as always I would like to thank you for joining us today. Now, it's my pleasure to welcome back Peter Davies from Jigsaw Trading for today's webinar, Improve Your Trading with Market Correlations. This webinar is sponsored by Canon Trading. If you have questions, please feel free to type them into the questions box, and we'll do our best to answer them by the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar, and as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Elon and Peter. And Elon's going to do a quick little introduction. And you'll get the pop-up to share your screen, Elon.
Excellent. So I'm going to show my screen right now. Thanks, everybody, for coming. I'll make it short and sweet so we can get to the point with Peter and learn more about market correlations and how you can improve it. How you can improve your trading. I did want to share a couple of things that I thought timing was excellent. The first one was we got this cake today from the guys at Futures.io. Happy anniversary to Canon Trading, futures destination for over 30 years. So I thought it was really relevant to show that as we start the webinar, including a very cool cupcakes that our brokers are going to regret in a few hours, but very yummy. All joking aside, Canon Trading been here since 1988, which is a big milestone in this business. And when you have a chance, after the webinar or at your free time, visit our website, check out the commission, match and beat, the different educational guides, including our our blog that is published daily. And like all of us, I'm eager to listen to Peter. We've done more than a few webinars with Peter, and he's a very knowledgeable trader, understands quite a bit about different aspects of trading, technicalities, order flow, and much more. And I know that as traders, you're taking a great step by attending this webinar and furthering your education. As far as the disclaimer, Futures.io did a great job there flashing the disclaimer off and on. But really the bottom line is this is Peter's opinions. He's going to share with you. It's up for you to listen, decide if you like it, you don't like it, maybe paper trade it, maybe implement it. Anytime you trade futures trading, make sure you're using risk capital and understand that this is risky business. Risky business and futures trading is risky. So at this point, I appreciated Futures.io, Terry, and of course Peter, and I look forward to listening to the webinar.
Okay, thanks, Ilan, and thanks all for joining. Let me just share my screen. Okay, so you should be seeing my screen now.
Yep, sir. Looking good. She's all yours.
Okay, so this is me. Just thought I'd flash up a picture of me so you know who's talking to you. This is me at a prop firm in London. It's not my desk, just one of the prop firms that we work with. What I'll do is we'll just go on and talk about what we're going to cover today. So we're going to look at something, it's not earth-shattering. It's something quite simple and very useful. Something that you will need to practice to get full value from it. And to help you on your way, what we'll do is we'll talk about the theory, and then we'll look at a number of examples to show you what it is you need to see in real time, how obvious or subtle the signals that we're going to show you should be. And we're going to be looking at market correlations. And correlations can really help in your trading. Now, there are some entry techniques that we'll briefly cover that you can employ purely based on correlations, so like 100% correlation trade. But today, we'll focus mostly on the simpler techniques you can use to actually improve your trading, to help you stay out of trades that would immediately go against you, to help you get a better price, and to help you understand when the market is changing pace. Now, first of all, we've got to figure out what is a correlation. Well, correlations are enforced relationships between markets, enforced by a certain type of trading, which probably many of you already know, something called arbitrage. So arbitrage is really simple. Basically, when you have two markets that are considered to be related, so this could be the S&P and the NASDAQ, it could be crude December against crude January, it could be different interest rate products. But if you've got two markets or more markets that are considered to be related, and then we have some kind of divergence between those markets, traders will jump in, they'll buy one of them, sell the other one, and they'll make money when the markets come back in line, as is the case right here. So here's just an example. It could be any two or more markets that are related. And the key with the arbitrage trade is it doesn't matter what happens in either side of the trade. It just matters that they come back in line. So this trade here, where the market that we sell moves upwards, is just as profitable as this trade here, where the market we sell moves down. So simply put, the profits come when the markets move back in line, right? Very simple. Now, the interesting thing about this is that this arbitrage trading is actually one of the things that forces markets back together. Obviously, if you have a lot of people sell this market and buy this market, they're going to come back in line. So in a way, we can say that these arbitrage traders, or the arbitrage trade exists because of the relationship between these instruments. But we can also say those relationships exist because of the arbitrage traders. And that's like a little bit of a chicken and egg situation, I know. But, we just have to, that's the way it is. And we just have to take that as read. So if you look, for example, at the correlation between the Dow, the NASDAQ, and S&P 500, they're all US stock indices. They all have different stocks in them, but they're all part of the larger same economy. So you're unlikely to see the Dow Jones sink for 6 months, while the S&P 500 rallies to new highs in the same period. So what happens when these instruments do move in a different direction in the short term is that we see arbitrage traders step in. And like all trading, arbitrage trading is competitive. One player might be happy to trade like a 20-tick divergence, but somebody else decides I'll jump in and trade a 19-tick divergence, which is why a lot of arb trading is done by HFTs, to try and get in first for a smaller and smaller divergence. So when the arb trade is on, we can actually consider HFTs to be our friends when it comes to using correlations, because the arb trade isn't always on. Okay, so correlations, if one thing correlations are, is they are inconsistent. And there's two types of inconsistency when it comes to looking at correlations. There's a long-term inconsistency. So, if we'd have looked back 10 years ago, it was quite normal to see an inverse relationship between the stock indices and the interest rates playing out intraday. So one would go up, the other would go down. But as we went through a period where interest rates were close to zero, with really no chance of moving for years, we saw that correlation between interest rates and indices break down. Now, that's not a huge problem for us. It just means we have to use something else. So that's one type of inconsistency. And then you get times intraday when the correlations break down, and they can break down for minutes or they can break down for hours. And that is actually good news, because this inconsistency in correlations is one of the things that helps you understand the overall state of the market. So let me repeat that. The fact that correlations are inconsistent actually makes them more useful. And it's a bit counterintuitive, but it will become clear as we move forward. Now, what correlations are really about, to me, it's about participation, because there's a difference how you trade like a lackluster, low participation market and how you trade a real bubbly, exciting, lively market. So if there's a healthy amount of participation, then you're going to see high correlation, which means a better chance of follow through on any moves in the market you're trading. But if there's really nobody interested, the market is just milling around in different directions, all doing their own thing, what you're going to see there, low participation, low correlation, a lot of chop, a lack of direction. So it's the old chop versus trend determination, right? With correlations, you're going to get the earliest confirmation possible of the market switching between trend and chop mode, which on its own, if the correlations just did that for us, that would absolutely be more than enough. So as an example, if the Dow is currently moving up and the Nasdaq's moving down, the chance of chop on the S&P is really, really high. And the chance of pop or follow through on the S&P is really, really low. Now, of course, you do need to watch this yourself, but consider the markets like, these two parties here. Sometimes you go to a lively party and sometimes not so lively. Sometimes the arb trade is on, sometimes it's not. If it all goes quiet from a correlations perspective, you're going to get that earliest heads up that we're now potentially entering a slow patch. And before we look at the use of correlated markets with some examples, let's just talk about what this isn't. So a lot of people think that when you watch multiple markets that you're looking for a leader. And I often get asked questions like, does the Nasdaq always move before the S&P? And it would be fantastic if it did, wouldn't it? Because after all, that would literally be free money if you could just watch the Nasdaq break and then trade the S&P. Now, the way it works in reality is there are absolutely times when there is a clear leader, but that's the exception, not the rule. So don't come into this thinking that you're just going to watch one market, wait for it to move, and then trade another, because that's a little bit unrealistic. But there are times when one leads, and it could be the more volatile one. If you look at the stock indices, it could be the Nasdaq leading, could be the S&P leading. It happens sometimes. You can take advantage of it when it does, but it's not going to happen all the time. Now, where do we actually look? If we're going to look at correlated markets, what is the best tool to look at? Well, you can see correlations in the depth of market and the charts, and each one of those has its own advantages. Now, we're going to start off looking at the depth of market first, and we'll switch to charts later. But the bottom line is, it really comes down to how thick the market is, and we're going to see that. And also, the number of correlated markets you've got available is quite limited. Whatever you trade, there's going to be a certain amount of correlations. You might personally like to trade and work with volatile markets, but the correlated markets available to you are much slower and much thicker. And if so, those are the markets that you're going to have to use. So for slower markets, the depth of market works better for correlations, and for faster markets, the charts look better. So what we'll do, we'll look at the DOM first. In this first example, we've got the US stock indices. We've got the Russell here, the Dow, the Nasdaq, the S&P. The first thing I'll say, the Russell's here for decoration more than anything. It is a stock index, but personally, I've watched it. It's not even on my screens at the moment. It's just not very useful for correlations on the US stock indices. The Russell itself, it was on ICE, Intercontinental Exchange, moved to CME. I think it was earlier this year or late last year. And when it moved, it was traded really lightly. It's got more volume now, but it just doesn't seem to be that highly correlated intraday with the other markets. Really haven't found a good way to utilize it. So really, the reality is, for these three markets, we're left with the Dow, Nasdaq, S&P. And of course, the S&P is the slowest and the Nasdaq is the fastest. Now, the first thing we need to look at on the depth of market is this white line here. You see this on a lot of domes. It's just called the center line, right? And that just means it's in the middle. And it can be reset. Most domes give you the chance to reset that every time. And that's an absolutely essential component of reading correlated markets. So if you're using a DOM that doesn't have this center line, it's going to be really difficult to read correlated markets. Because what we're trying to do, if you look at this, you can see, wow, there's so many numbers on there. But we're not trying to read all the numbers on here at all. Most of the time, we're just trying to eyeball, quickly glance at how far each of these markets has moved from this center line. Because using correlations, it's a part of trading, and it shouldn't take up most of your energy, right? It's a quick eyeball thing. So I'm not trying to give you something here that's going to consume 50% of your trading IQ. I'm giving you something that's really useful but doesn't consume a lot, 5%. So it's a quick eyeball thing, and what we're trying to do, say, is eyeball movement away from this center line and try and eyeball a little bit the balance of trade. So you can see on the Dow here, we can see the trade balance is a little bit heavier on the buy side. So we can see these center columns basically. What we're showing is the sell market orders on the left, buy market orders on the right. You can use a footprint chart for that, lots of different ways to see that, right? So again, it should be quick enough to quickly glance across and actually see the balance of trade. We can see It's heavier on the buy side here. We can see it's heavier on the buy side, although we've just got this one price here where it's a little bit heavier on the sell side. Okay, just a quick eyeball. Now, the other thing we can see on here, we've got a market moving up. We can also see we've got a pace of tape indicator here that's showing the markets are all kind of just healthy. They're in the yellow. It's medium. Market's not spiking. We're just seeing good, regular upside momentum on all three markets. So we're moving up. S&P is at the top of its range. So is NASDAQ, although it's just fallen back a few ticks, and so is the Dow. But everything's moving up. Now, you can see here an order on the NASDAQ for a long. So basically that would be about breakout trade. As the NASDAQ is a lot more volatile, the order's not going to be at the top in a breakout. We've got the volatility, should give us a chance for some price improvement. Now, whether you agree with going long at this point isn't really the point of what we're doing in this webinar. What's important is that there's now, at this point in time, this market or these sets of market are leaning in one direction. They're leaning to the upside, right? So they're leaning one way, and it's just like the tower leaning left here. Right at this point in time, if you look at that tower, you can say, you know, with pretty high confidence, the chance of it falling over to the right now are fairly low. And the markets lean up and down too. So when people consider, you know, correlations, they're usually thinking about movement. It's not really about movement in a lot of markets. Some markets can trade a lot, can lean to the upside or the downside without moving, right? But if they're heavily one-sided, it just means they're leaning in one direction. So in the short term, if you've got a set of correlated markets that are basically leaning in one direction, the probability of a short spike in the opposite direction is really quite low, right? So that in itself represents a kind of short-term safety net for any trade you take in that direction. So it's not a stop loss, it's not a setup, it's like a safety net. And you can see this if you see with breakout trades. If you see all the markets leaning to the upside, and you take a breakout side to the upside, as long as those markets are leaning to the upside, you can stay with that trade even if if the market hasn't moved up. The moment they start to backtick, they'll slowly start to backtick, kind of just starting to get a feel for the downside, and that lean's gone. You can scratch that trade, right? And the market hasn't hit any stop. The market hasn't moved. It's just stopped leaning to the upside. You kind of lost your safety net. What you were hoping for, that the market was leaning to the upside and then it would break. But as it starts to probe back down, you can say, well, that's, you know, that is off the table for the moment. It's easier to think of it this way. Let's say, another way to look at it, let's say this is the Dow, NASDAQ, and S&P, right? All three markets, all heavily imbalanced to the sell side. NQ, Dow, tearing down, and S&P has just got to a place that you consider to be support. This is the opposite of having a safety net, right? If you wanted to go long on the S&P right now because you've got some kind of price that you've defined before the market opened, you've got all three markets moving down. Well, of course, you want the S&P to be moving down because you want it to go to the price where you'd like to go long, right? You've set that price before the market opens. But if also the Dow and the NASDAQ are tearing down, you don't have any safety net on that long trade, right? There's nothing leaning up. Everything's leaning down. And it might just be better to wait for a sign that the markets are slowing down or going neutral, or at least a couple of them starting to lean to the upside. Doesn't mean you've got no trade on the S&P. Just means you want to wait a little bit. You know, it's not rocket science here. You know, so, you know, you could wait for instance, the Dow, the NASDAQ to level off a bit. You might want to wait for something like this, where your S&P is still moving down to your price. You know, the Dow is flat and the NASDAQ's just starting to tick up. Anyway, on a breakout to the upside, safety net would be that correlated markets are leaning to the upside, or at least on a reversal, you know, that they've become neutral. So if the market starts leaning in the opposite direction or it becomes neutral, you can reassess what you want to do. You don't have to get out of the trade, but you can reassess. You've got some more data. You can cancel orders, you can exit the trade, you can wait a little bit. Now, it's a little bit different from managing a trade based on a move against you, but it's absolutely valid. So you can manage the early part of a trade Two, once you've got in, based on how the market's trading, rather than whether the price is moved against you. And again, especially on breakout trades are trades where you want them to go or not, right? So if you're on a breakout trade and it breaks up 2 or 3 ticks and there's no stop run, and then the market starts to, a couple of markets start to tick down, you haven't got your stop run. You've broken out a couple of ticks, but nobody's stopping out. Now, of course, this is all very short term, you know. In some cases, seeing this lean against you, it's going to see you passing on a trade. In some cases, it's just going to see you getting in at a slightly better price. Anyway, back to the screens. So what we've got here, we've got an order that got filled on the NASDAQ. And what we've done now is we've actually cleared the trade columns in the center here, and the DOMs have recentered, right? And one of the big benefits of using the depth of market over charts is that you can recenter the depth of market, right? In fact, with this one, the Jigsaw DOM, it'll actually recenter when you get filled on that position, right? The current trades here in the middle also clear. It's very simple stuff, but very effective. So we've got in a trade, everything's recentered. It's a couple of minutes on. What are we seeing? Well, if you can't figure out which way the markets are leaning based on that, well done, because you can't tell. So basically all that's happened here, not a great deal. The Dow's slightly above the center line. The NASDAQ and the S&P are around about the center line. Just not a lot going on, so no point jumping to conclusions. You know, with correlations, it's like anything else in the market. You do have to let things play out a little bit before it becomes clear, right? There's no lean against us. There's no lean our way. Okay, let's move on 1 minute. Now, here's a perfect example of seeing a lean in a thicker market, right? So we can see that on the S&P over here, we've got 286 buys against 97 sells where we've traded at the moment. And at the same time, the NASDAQ has moved up 12 ticks. And those two things there are exactly the same thing. So even though the NASDAQ has moved, but the S&P hasn't, from a correlations perspective, they've just done the same thing. They're both trading, they're both leaning upside, they're both trading more heavily on the buy side. But the S&P is a thicker market. It takes a lot more orders to make it move. Okay, so like I said, you don't always have a choice about whether you're going to have to watch a more or less volatile market than you want you trade when you use correlations. In this case, S&P is a lot thicker. But still, really, if you think about the way the NASDAQ moves, and if you look at the Dow, none of these markets have really moved a lot. What we've got is we've got a push up in the NASDAQ. We've definitely got the lean in the S&P, but we don't have any follow through just yet. Now, before I change slides and go to the next slide, what I want you to do, because I want you to get a feel for how easy this is to do, I want you to focus here on the Dow, and here on the NASDAQ, and here on the S&P, and just see if you can figure out how long it takes to tell if there's a bias in the market, if there's a lean in the market. And I want you to do that just by looking at those things. This area here, looking at the current trades and the center line. So I'm going to go 1, 2, 3 and switch slides. Okay. So it should normally, I know you're looking at this for the first time, normally it's a couple of seconds, right? It's very clear now, right? So even though the Dow and the S&P, they haven't broken the high of the day yet, unlike the NASDAQ, we can see they're most definitely leaning to the upside, right? You can see there's a lot more size on the buy side here. We can see we've got that progression up. We can see there's a lot more size on the buy side in the Dow, and we've got progression up, right? And that's it. That's really what you want to see, right? And it's key because, you know, you need to use correlations in the heat of the moment. So this can't be a science project. It has to be something you can process quickly. So looking at this quickly and the move from the center line should be something you can process without too much effort. And there's two ways you can use this, right? So if you're trading DAX or NASDAQ, very volatile instruments, you can expect a lot of minor swings in any move up, right? So there'll be swings back on the NASDAQ that don't appear in the Dow and the S&P. So this overall lean in the market can be used to, one, stay in the trade, to understand that any minor swing back in the NASDAQ is just that because the overall lean is still to the upside, or two, to actually get into a trade. So if the NASDAQ puts in a minor swing downside, but the overall lean is up in the other markets, you could actually enter the NASDAQ when it puts in that minor swing against the trend, right? And that's very useful if you're trading a volatile market and you miss a move, because it's very easy to miss moves in volatile markets. Okay, so that's looking at the depth of the market for correlations. Let's just compare that with the charts. So we're actually going to use the same markets, the Dow, NASDAQ, and the S&P. So Dow here, NASDAQ here, S&P here. Now we can see that right now, the NASDAQ and the Dow are actually starting to move to the upside. Now, if you're going to use correlations, time frames are really, really important, right? So we're looking for local, very recent action. So if this was a 30-minute chart, for instance, this is 30 minutes going to, we're at 2047. So 30 minutes would take us to before all of this activity, and 30 minutes would cover all of this activity we're seeing on here. So if this was a 30-minute chart, on both of those, we'd actually be right in the middle of a 30-minute candlestick, right? All of the action that we're seeing on those two charts would be in the same bar, we'd be in the middle of it, and it would be almost impossible to really get a handle on whether these markets were really moving in sync. So with correlations, it pays to keep the time frames as low as possible because it's more readable. Anyway, we can see the Dow and the NASDAQ. They're not well correlated. They weren't well correlated earlier because you can see the Dow's been marching down. With the NASDAQ, we had the move up before we started to move down. So they weren't correlated earlier on, but actually right now it does appear they've come back in line. The way we're moving up here, these two moves are very similar. So at that earlier point in time with low correlation, we'd have expected low participation, non-directional moves on the S&P. But now the market's switched gears, the market's now back in line, Dow and NASDAQ are moving together, means there's a good probability that any trade on the S&P will have follow through. So right now, all three markets are leaning up, and that means for any long trade, we've got a little bit of breathing room. So once again, I'm going to go to the next slide, and when I go to the next slide, just look at the Dow chart, the NASDAQ chart, and the S&P down. So I'm going to go 1, 2, 3. I was a bit ahead of myself there. Okay, so do we see that? We can see this little push here in the NASDAQ, a slightly smaller push on the Dow, and we can see there's that lean to the upside on the S&P. We can see 230, 291, 199, right? It's basically the same as last time, just a chart view rather than a DOM view. So we can see healthy participation up on all three markets, green bars on this Vista chart here. That doesn't mean we've moved up. It actually means there's more buy market orders than sell market orders. So we can see that line to the buy side on all three markets. Now, you might say that this is obvious, right? And if you say this is obvious, I would agree absolutely 100%. If it's not obvious when you're reading it, don't overanalyze it. Just call it neutral, call it call it unknown, call it it's not helping at the moment. Now we move on. As we move on, now we start to get a counter trend move. Right, so what do you do? What do we typically do? If there's a counter trend move, we're in a long trade, markets move against us, very good chance of getting wiggled out of a trade, right? So how do we assess that a pullback is actually a pullback? Well, we're looking at high participation, healthy correlated set of markets. So if you see pullbacks in all three markets, that doesn't mean it's going to reverse. You actually probably will see a pullback across all three markets because they're highly correlated. So what we can see is the Dow's moving down, the S&P's off a few ticks, and the NASDAQ's kind of moving down. It's just not a very big move at the moment. So what you can see in all three of those markets right now, the move back looks pretty weak. It doesn't look like there's much strength behind it on any of those markets. And this is where that screen time is going to pay off. It does take like a few weeks of just watching these correlations to see them fall apart and come back together, and just to get a handle on the strength of the moves, because you will absolutely see markets pull back together, but that doesn't mean you have to get shaken out of a trade. So in this case, it's pretty clear the move is not strong in any one of these markets. And once again, this is just a trade management technique I'm discussing, but you could just as easily use this to enter long in any one of those markets, right? So you can see we have an upward upward momentum in all three markets. We have a short-term weak move down that looks really, really tired and lazy. We could get long in one of these markets. If we wanted to get long in one of these markets and pick one, maybe the one that pulled back a little bit more. So if you've got one market pulling back a little bit more, the other two looking strong to the upside, the one that's pulling back a little bit more is actually giving you some opportunity. It's actually saying it's giving you a bit of price improvement over the other two markets, right? So what we're talking about with correlations, it's not really like an entry technique. It's a market reading technique. So you have to be open-minded how you use it. You know, it can be just, I was right about direction, I missed a trade, now I'm going to wait for one of the markets to kind of pull back a bit more than the others, and then I'm going to get in. You can use it however you see fit. Now, of course, markets continue to move up. We can actually see the pullback here that we saw on the Dow was actually down here, barely visible on the NASDAQ. And of course, you could have been trading any three of these instruments with these correlations. So this isn't just about trading the S&P either. It's just an example of the sort of activity you see in correlated markets, how they're going to move together, take off together, pull back together, and how they can be of help. Now, of course, not all correlations are where markets are moving in the same direction. We also have inverse correlations, and we also have really, really thick or really liquid markets. So with the correlations, you've got one kind of issue that you can't always pick the type of market you like. You know, when you pick a market to trade, if you like a fast market, you like crude, you like NASDAQ, you can pick the kind of market you like, the kind of volatility profile. With the correlated markets, you have to take what you've given, you know, what's available. So thicker markets, thinner markets, or inverse correlations. Just got to use what's available. So in this case, we're on Eurex. We've got two interest rate products on the left, and they are inversely correlated with two inverse index futures on the right. So the two on the left will go down if the two on the right go up, and vice versa. So what we're going to do is we're going to move on to the next slide, and I want you to just eyeball the center line on all four markets and think about which way they're leaning. Okay, now it's a kind of a different story, right? So what we can see here, the bobble on the left here, it has not moved, but it is much heavier on the sell side. If you can see the amount of trade on each side. The bund is heavier on the sell side, and it's moving down. Now that effectively is exactly the same thing on those two markets. That is a lean to the downside. But because of all this liquidity on the bobble, it just takes a lot more trade for that market to move down. DAX, on the other hand, totally useless, right? So if you look at all the prices it's traded there, the DAX has actually traded up and down while this little bit of activity happened on the bund of the bobble. The DAX has traded up and down, and the DOM's moved that far, it's automatically recentered, right? And you can see the DAX chart over there because the DAX is just way too volatile to be of any use as a correlated market. Now, you can trade the DAX looking at other correlated markets, but on its own, it just moves around so much. It's almost impossible to read for correlations, for me anyway. If you're using the chart, of course, it makes it a little bit of a different issue. If we look then at the stocks, the Euro stocks here, we can see, yeah, that's moving to the upside. But again, it hasn't really moved a lot. Right? We've got 5, 10, 42, 8, 9, 5, but it's leaning to the upside. Right? We've got that imbalance there. So once again, the trade there is supported by the other markets. We can forget about the DAX, and those other markets are actually moving in the opposite direction. So what we're going to do is we're going to go to the next slide again, count to 3, and just take an assessment of what's going on in these three markets. Just look at these three columns. Okay, so it's pretty clear, right? You can see the bobble on the left. You can see it's marching down nicely. Just look at the trade size there. Hasn't moved a lot, but it's marching down nicely. We can see exactly the same on the bund, marching down nicely. A lot of trade on the sell side. Over on the stocks, it is moving up, but you can see that balance of trade is kind of shifting, right? So there's a lot of volume at the top here, and it's not moving onwards, right? So if we look at the volume it took to move through each price on the way up, you know, it was like in the 200s, 300 there, and then it's gone to 1108, and then it started to trade on the other side, okay? It doesn't mean the market's definitely going to reverse. It just means I'd just keep a heads up. So Excuse me. Sorry. So we want to make this easy for ourselves, right? So we've got a scenario where we're in the middle of a trade and we think the market might be stuck. Now the Euro stock's on the right there. It doesn't move a great deal. So we think we might be stuck. Want to make this as easy for ourselves as possible. If we think it might be stuck, we can go do a couple of things. We can recenter all the domes. So we've just got a view of what happens after that recenter, or we can clear the trades. In this case, what I do is I actually cleared all the trades. So I actually cleared all the trades from the middle. I didn't recenter. And now we can see what's trading. So which way is this market leaning now? Right? What we can see is the stocks is leaning to the downside. The bubble, again, it had this big, the bubble, it had this big area of high volume here, and it started to tick up. Bund is very heavily leaning to the buy side, right? So on these particular markets and with the stocks over here, it's not a very volatile market. That, you know, that three ticks down is a significant trade. For me, that's enough of a sign on these three markets to say the tide's turned, everything's moving against me. Different volatility profile, slightly different signal. Okay, so there we get the trade, and indeed that was where the market did reverse. Okay, last thing we're going to look at is the concept of switching state, going from trend to chop or chop to trend, and how correlations help with that. So first of all, do these markets look correlated? Well, obviously not. You've got the Dow going down and the Nasdaq going up. This is really, really common on the indices. Now, you could say, but the S&P and the Nasdaq are correlated. And that's true, but there are actually only two directions. So, of course, even in non-correlated periods, we're going to see markets in the same direction. And this is an experienced thing, but if the Dow and the Nasdaq aren't going in the same direction, then more often than not, the S&P will chop. So for US indices, assessing market state, my experience is that actually comparing the Dow and the Nasdaq is key. Right, if we move on, we can see here, the Dow is marching down, Nasdaq still moving up. And in the meantime, what's the S&P done? Well, it's made a move towards the prior low, moved down to here. It's actually failed to get there. We can actually see it's just here. It didn't actually manage to get through that. That's very typical of what you're going to see on the S&P when the Dow and the Nasdaq are moving in different directions. And if you haven't seen that before, just pull up a 1-minute chart of the Dow and the Nasdaq tomorrow and just watch what happens when they start to move in different directions. So with this kind of market, you would be looking at a range trade. So you would buy S&P in this situation. You would look for a sign that the S&P is going to hold. Your expectation would be that the fade trade is the one to take on the S&P, right? So we take the lack of correlation to determine that the S&P is directional, and that at some point it's just going to start. It's just going to hit the bottom of the range or fail to get to the bottom of the range and start to turn up. And it's really important to be able to do this, because the best place to enter in a trading range is the worst place to enter in a trend, and vice versa. The two conditions require opposing strategies. So it's good to have a heads up when the market shifts from trend to chop. Now, in this case, the correlations give us the heads up right from the start that we've got a low energy, low correlation market with poor chance of follow through. So in this case, there's no trade to show you, just wanted to show you the activity. Now, if we had strong movement down on the Dow and the Nasdaq, you would not consider taking a long on the S&P here. The chance of follow through to the downside is far too high if all markets are tearing down. Now, what I'd like to do is just take a note of this 90.50 price, because that's as far as we got down to the downside. So you can see markets were low correlation and it was fade territory. But what about now? Is this a correlated or uncorrelated market? And I would say this is correlated. So there's no breakout. We don't have any spikes up. We don't have any big moves, but we do have the markets back in sync again. Now, one thing this is ugly, right? This is not a pretty chart. But if you look at the shape of the move across the three markets, you've got this U shape here, here, and here. You can see that the markets are basically doing the same thing. So when we look at for correlations to kind of kick in again, Don't think of it as all three markets just pushing dramatically in one new direction. Just look for them literally to start moving together. Because the appearance now, to me, is that we've switched gears, and so the chance of follow through on a move, on a trade, is actually quite good. So it's not pretty, but it is correlated. So don't wait for pretty. Don't wait to see some big, bold, brassy move. Often what will happen is the markets will come back in line before they pop. So it's the subtle stuff that's most rewarding in trading, in my opinion. Stuff that you can see that will kind of tip your hand before other people see it. So in this case, markets are back in line. They are ugly, but indeed back in line. And this is where we ended up. 4.5 points of ugly, but directional action. So you can see there's even areas of absorption here, this area here, that match on both sets of charts, here and here as well. So it's difficult, in my opinion, to tell from just one market if we're switching from range mode to chop mode. And most chart-only traders would need to wait for the extremes of the range to be hit 1 or 2 times before they know it's a range. Correlation traders have a much better view of the shifts in that market state as they appear. Okay, before we finish, here's another one. Let's presume for a second that this is the S&P, the Dow on the right, and the NASDAQ in the middle, right? The NASDAQ is the more volatile market with a lot more backticking. This is the correlation entry, right? The correlation entry is when you've got a directional market and your more volatile market pulls back, right? So keep this in mind. One of the keys with correlation trading, it's about reading the market. It's not really about any particular entry type, but if you do miss a trade and you know the markets have turned around, this scenario is just one of the chances where you might be able to get in again. And it's not necessarily always the most volatile market that you can get the pullback on. So just bear that in mind before we close out. So what we talked about to now isn't rocket science. You can boil it back down to basically a few useful and fairly easy things to implement. So you can better understand the current state of the market by whether the market's correlated at all. If other markets are clearly against you when you want to get in, just wait, right? If you just wait, if you want to go long and all the markets are against you, you can probably get in at a better price. If other markets are clearly with you when you want to get in, it gives you a bit of a safety net. And just think about that safety net when you're getting into the trades and what happens when that safety net's there and when it isn't. And just observe that, and it will help you manage your trades in the future. So if the other markets go against you after you get in, it just reduces the probability of that trade being a winner, right? So it's really about markets leaning or being heavier on one side. In a thinner market that produces a more visible move, that's great. A thicker market, it's not very visible. There's not going to be much move to see. The market's going to lean, but there's not going to be a lot of move. It's just going to trade heavier on one side. It's exactly the same thing, right? On a volatile market, you see a move. On a thick market, you don't see a move, you just see an imbalance. Now, all of this takes a little bit of experience. So don't expect to sit down tomorrow and master this in one session. Just get used to how the markets move. Find the most reliable correlations, because there are plenty to choose from. And occasionally there will be a leader, but the value of correlations is about more than follow the leader. It's about that participation. So, that when there is a clear leader, that's just an occasional nice to have. Now, of course, some markets don't have many correlations. Crude oil is a good example. But with crude oil, you do have different calendar periods used by spreaders. You've got other energy products. You've got the dollar index. And also the Canadian dollar is a really good indicator for crude oil. Now, there's been quite a few times this year when the crude and S&P have both been really slow. Obviously not this month. And then they broke at the same time. On quite a lot of occasions, you'll find crude has broke like a minute or two before the S&P. So just be aware that this benefit is out there. Lots of people using it. It's useful, more useful on some markets than others. We looked at index futures today. We looked at interest rates. They're very similar in terms of having good correlations. Grains, meats, metals, whatever you trade, all very interesting. Then there's particular trades that have low requirement for correlation. So if you look at a news trade, an FOMC trade, a trade off a volume spike, exhaustion, there are some trades that just their nature makes them more violent. And in my opinion, those periods when the markets go really violent are periods where the individual markets do their own thing anyway. So as such, it's kind of a lot to expect correlations to help on those trades. So if you're trading the FOMC very close to the announcement before it's had a chance to calm down, I don't think the correlations are going to help you much. Now, as we go into the Q&A, I did tell you there'll be a freebie today. What we got today, we got a 3-part course we recently created at Jigsaw. We did create it for customers only, but we're going to give you that free today if you sign up in the next 48 hours. It breaks down the process of implementing a profitable strategy and detail the things that will most likely occur to make it appear that strategy has stopped working. So if you've ever tried something and it's worked for a couple of weeks and then it stopped working, we actually talk about how to deal with that and why it's pretty much guaranteed to happen for any strategy you apply. If you're hopping around from one technique to another, this will be really useful. And all you have to do is go to canontrading.com/tools/123. I'm just going to leave that up there for a couple of days and close it because it is normally for customers only, and they'll probably get annoyed at me. So with that, Terry, do we have any questions?
Yes, if you have questions, please feel free to start typing them in, and I will ask them to Peter. On your depth of market, what are the gauges at the bottom?
Those are things that we call power gauges. We've got different gauges for different things. The ones I was using there were for pace of tape, which shows you how frequently the trades are hitting the market.
Okay. Are there certain times of the day when indices are more or less correlated?
Yeah, I mean, yeah, and it kind of changes. There's kind of long-term patterns with it. So for a lot of days this year, we've had days where they've kicked off and the markets have been uncorrelated, like from the open, and then like about 30 minutes in, they'll just catch up. You've got a lack of correlation at lunchtime, very frequent. So if you think about when the markets are the most lively, that's when they're most correlated. But like I said, there's been a lot of days this year. We've had quite a few unusual things this year. One is that we've had a lot of days this year where the overnight moves have kind of been better than the day moves, and then we've had the correlations then. We've had a lot of days where the markets opened with low correlation, then picked up about 30 minutes in. So normally I would say, normal conditions before this year, I'd said, 9:30 onwards, we get good correlation and it dies out towards lunch. But there are kind of long-term patterns that come into the market and just change over time. The time it's going to affect you the most is when you first start learning this. So when you first start learning it, it's going to take a little while to pick up on this. But after a while, you'll actually see those patterns emerge yourself in terms of, the correlations are changing a little bit.
I do have one quick comment about the free offer trial, Peter and Terry.
Yeah.
Once you sign up for the free offer, we will, with your permission, obviously, send your email and name to the team over at Jigsaw, and they'll set you up for the access to the course. So just be aware of that, and that's how we're going to set it up. As like Peter mentioned, it's a special offer. It'll be there for a couple of days. So you sign up, our brokers tomorrow morning will send the information to Peter's team, get you set up, and reply back with an email.
Okay. There's a question that says he's already a Canon member, and what platform are those DOMs on?
That was on the Jigsaw trading platform. It's a platform called Day Trader. So if you should be able to find the Jigsaw trading site, but that's basically our trading platform.
All right, then we can connect that for Canon members. You got to discuss this with your broker, and he'll connect the data feed, the right data feed, and then tell you how to access that specific platform.
Okay. I'll give him another minute or so.
Yeah, so just be patient. Once you sign up, our brokers will be here tomorrow morning, which is U.S. time, obviously, and get you set up with access to the course and send you an email. So just make sure you provide a legitimate email. Otherwise, there's no way to reach you.
Yeah, if you do sign up, by the way, I'm not going to add you to the Jigsaw mailing list, so you're not going to get a bunch of emails from me. So I'm just going to add you. I just need to add your access for the course.
Okay, I think that's all the questions. Thank you for the webinar today, for the information, and oh, wait a minute, we just got one. Let's see. So, would you define short-term value as the relationship between different instruments?
Absolutely. I mean, absolutely. If you think about what the arbitrage trade is, the arbitrage trade is keeping the market in line. So if you've got that scenario where you've got the S&P and the Dow on the upside and the Nasdaq comes down, then temporarily the Nasdaq's kind of below value. And absolutely, and that kind of correlation play is effectively a value trade.
Okay. Can you describe other markets where you've seen correlations other than those discussed today?
To be honest, I mean, the ones I trade the most, or the ones I have traded, interest rates, stock indices. But again, if you look at things like, you know, the grains, there are correlations across the grains. But again, I don't look at lots and lots of different markets. So I like to keep it to the markets I've discussed today. But like the energies, you've got stuff in the energies where they'll move together. Crude's a little bit tricky in terms of correlations. But like I say, the currencies and other energies are where you look with crude. But I don't want to go outside my area, to be honest.
Okay. Okay, I think that's it. Again, thank you for the webinar, for the information, and for spending some time with us this evening, to the both of you.
Thanks.
Thank you, Terry, and thank you, Peter, and thanks everybody for taking your time to attend the webinar and furthering your trading education. Feel free to visit us for the free offer that Peter mentioned, as well as in general. There's a lot of educational resources we've collected over the last 30 years. CannonTrading.com is the website. Enjoy your evening or day if you're in a different time zone in the world, and futures trading is risky and not suitable for everyone. Good night.
Night.